Welcome to Yahoo Finance Live. I'm Shauna Smith. Let's get you caught up with today's market action. We've got about an hour to go in the trading day. You're looking at a mixed picture with the Dow holding on to gains up just 85 points, but you're looking at the S&P and the Nasdaq trading to the downside. Tech, one of the underperformers in the market today, with the Nasdaq off just over 1%. We've got our eye on two stocks for you here today, Walmart and FedEx. Both of those companies holding their investor days today. Walmart is focusing on automation, also the health of the consumer, while FedEx announced that it is combining its Ground Express and other units into a single business as part of its cost-cutting measures. We will have analyst takes on both of those stories coming up. But first, we got to get you up to speed on the latest from the New York International Auto Show at the Javits Center. Dave Briggs on the scene live all day from the floor, speaking to the biggest names in the auto sector. Dave, what do you got behind you?
This is just an incredible audio-visual experience that I'm going to tell you a little bit more about in a moment. But first, a little pro tip for you. If you come down to the New York International Auto Show, which opens to the public on Friday, you got to wear comfortable shoes because it is massive. More than 1 million square feet here at the Javits Center, displaying more than 700 vehicles, 5 drive and ride experiences. They've got it all for you, but one underlying theme beneath all of it, and that is what's next in EVs, because that's what every automaker is doing, putting their electric foot forward first. I'd break that down into really 3 key categories, and that is 1, an expanded lineup of sport utility vehicles and pickup trucks, which we will show you. Also, the affordability element will take you to the sub $30,000 Chevy Bolt that has proven wildly popular. And number 3, connectivity and technology. You're seeing third-party apps incorporated directly into these vehicles and massive screens displaying everything you might need, and some of it that you might not, quite frankly, the length of your dashboard in some cases. And speaking of technology and enormous screens, you do not have to be a car guy or gal to enjoy the auto show. This here behind me is our nation's national parks, the backdrop to the Subaru Crosstrek Wilderness. It's rotating through all of our national parks, which are just brilliant. And frankly, it feels like the ground is moving beneath you at times, if you feel that at home. Bryce Canyon National Park is what you're seeing behind me. It is really cool. Here's what we got for you coming up. 3:20, Steve Center, Kia America COO and Executive Vice President. We'll show you the Kia EV9 that Edmunds calls a potential game changer because a third-row non-luxury SUV opens up an entirely new demographic. Also at 4:15, Mike Koval Jr. He is the Ram brand CEO. He's going to show us the Ram 1500 Rev. It is a killer pickup truck. It's big, it's beautiful, it's powerful, and most importantly, they'll tell you it has a 500-mile range. Why is that so important? Because its nearest competitors, the Ford F-150 Lightning, maxes out at 320, and the Chevy Silverado maxes out at 400 miles. So we've got a lot covered for you here. EVs are the theme, and again, a reminder, you don't have to be a real gearhead to enjoy this. There are audio-visual experiences like this one. You can do some curling and basketball and skateboarding over at Toyota. A lot going on here over the next 2 hours, Shauna.
Keeping you busy, Dave. I'm nervous to ask how many steps you've already clocked today. We still got 2 hours to go. You've been all over the place.
I think I'm above 10,000. Thankfully, got my Nikes on, my friend.
There you go. All right, Dave, I'll speak to you in just a few minutes. We also want to get you up to speed on the market action here because an hour to go in the day. We got the Dow up 74 points, S&P and Nasdaq in the red, with the Nasdaq still the laggard of the session, off just about 1%. First, let's also get a check on gold because gold has certainly been a trender today, just above 2,000, right near record levels. Ines Ferre has been closely watching that move for us. Ines, what can you tell us?
Yeah, that's right, Shauna. And gold bugs are really loving this moment with gold above the $2,000 an ounce level, inching towards a record high. It could be a series of days before this happens. Look, the JOLTS report sent gold higher today. It has flirted with this $2,000 level, but up until now, not closing on it yesterday, it did close at a 2023 high. Traders are basically betting that the Fed is going to have to pivot to perhaps cut rates later this year. And gold tends to do well under this scenario. When the markets believe that the Fed is pivoting or the tightening cycle is just about over, when the 10-year Treasury yield is lower, as we have seen it, and also when the US dollar is lower, as we have seen it lowering. And so that all helps buoy gold prices. Now, we saw an acceleration also when it came to gold prices in March. This is after the banking crisis. With that banking crisis, we saw investors flock to gold. And in fact, I spoke to one analyst that said most certainly there could have been flows of money that were going from the banks into assets like gold. Bank of America wrote a note saying a new all-time closing high in gold prices would go a long way in signaling significantly larger upside in 2023 to 2025. So that's the idea, that gold would do well this year and going into next year as well. Jana?
Yeah, and as taking a look at some of the other metals, we're also seeing this movement to the upside in silver, too.
Yeah, that's right. Silver around $25 an ounce level. Its 52-week high is 26.24. Look, it does have an industrial use. So I did speak to one analyst that told me that silver, he believes that silver will go higher, certainly. But he says if we go into a severe recession, because it has an industrial use, you could see a drop in demand when it comes to silver. Nevertheless, he is bullish for silver in the next couple of years.
All right, Ines, thanks so much. We also want to take a look at some of the broader market action. Jared Blickery is here to break all of this down for us. And Jared, when you take a look at some of the sector action today, we certainly are seeing a bit of a gap between the outperformers and the underperformers.
Yes, and the outperformers mainly defensive in name. You take a look at the winner there, that's utilities, XLU up over 2.5%, followed by healthcare, another defensive, energy, not so much defensive, depends on how you think of it, but definitely staples as well. So not a very bullish risk-on flavor in the markets. And I'm just going to show you the indices real quick. What's happening this week? Well, this week is ending up a lot more like 2022 than the first quarter of this year. Here's what has happened in the Dow. Let me just put this on a 3-day basis. You can see just barely positive 62 basis points, about 0.6%, versus the Nasdaq this quarter, 3 days, down 2%. So if we are reverting to last year, well, we all know what happened last year was not that fun. Another thing I'm looking at is regional banks, and especially a Western Alliance. Some things going on in particular with Western Alliance that I want to address, and then I'm going to broaden it out to the market as a whole. Now, first of all, this is a 2-day view, and you can see down 16% over these 2 days, and well off of the lows here. It had been down more, but what I want to point out is that the real selling took place today at 10 a.m. on that ISM services miss, and I think that's going to be a hairbinger of what happens with economic reports if they keep missing to the downside, because bad news is bad news. People are not pricing in Federal Reserve rate cuts because the economy is doing bad. They're pricing in lower stock prices because the economy is doing bad. Now, with respect to WAL here, there were concerns that they were experiencing more deposit flights. There was a key investor update yesterday evening that did not include statistics about their deposit flights for the first quarter, but they did update today. And in fact, they've been building deposits about $2 billion worth since March 20th. So it looks like WAL is in decent shape here relative to the circumstances, but I think because it's been experiencing such outsized movements today, you can really see some of the weakness embodied in WAL that you might not see other places. This is a bear flag. A lot of other regional banks and financials look like this. If this is the start of another leg down, well, watch out below. But for now, just a yellow alarm, Shauna.
Yeah, certainly something that's getting a lot of people's attention in today's action. Jared, thanks so much. Well, again, stocks are mixed as we enter the final 50 minutes of the trading day. Investors are starting to weigh what seems to be maybe a cooling jobs market. The latest data out from ADP showing that report for private payrolls came in just around 145,000, well below the street's estimates. We want to bring in Kevin Mon of Hennian and Walsh, Chief Investment Officer. Kevin, it's great to see you here. So taking a look at today's action, some of the technology names, chip stocks among the underperformers because, of course, that fear of recession may be creeping in as we start to see potentially the job market slowing. How are you looking at today's action and the data that we got out this morning?
Yeah, taking a step back, Shauna, and putting in a bigger perspective, as you know, my outlook for this year was better days ahead for the markets, but not necessarily the economy. I think that's holding true and coming to fruition. And this is all because the Federal Reserve, since March of last year, essentially told the markets that they were going to continue to raise rates and shrink the size of their balance sheet until something broke. Well, guess what? Something has now broken, as we've seen in the banking system. We saw the impact that those rising rates had on housing. We've now seen the impact that it's had on regional banks, and we're going to soon see the impact that that's had on earnings and the economy. For the first quarter of 2023, as it stands now, according to FactSet, the earnings of the S&P 500 are expected to contract, go down by 6.6% on a year-over-year basis. We know that the economic growth forecasts are positive for the first quarter, but we also got an update from the Federal Reserve last week, which suggested that GDP growth for the entire year of 2023, according to the Fed, is only going to be a measly 0.4%. So yes, the economy is slowing, and if there's a silver lining to all this, it's going to prevent the Fed, in my opinion, from being as aggressive as they want it to be to help combat inflation.
Well, Kevin, what happens, though, if the Fed does stay aggressive and we get another 25 basis point hike? How worrisome could that potentially be for you?
Yeah, as it stands right now, I think there is still a likelihood of another 25 basis point hike in May, but that will be it because they can't go any further. What did concern me, to your point, Shauna, is the most recent dot plot chart that was released after the March meeting, which showed that 10 of the 18 members believe that one more 25 basis point hike is in the cards this year. However, the other 8 members actually believe that there could be more rate hikes this year, and none of them are forecasting any rate cuts this year. If the Fed stays too aggressive, I believe they're going to push the economy into a deeper and more protracted recession than would have otherwise occurred on its own.
So, Kevin, I think a lot of investors out there are wondering what they should be doing with their money right now. Let's first take the opportunities that you are seeing in equities. Where are they?
Sure. And I think if we just expand our horizon out and go on a journey with me, Shauna, for the next 2 years, over the next 2 years, rates should be lower, yield should be lower, inflation should be lower, and markets should be higher. So how do you position your portfolios to take advantage of the end of this rate hike cycle when inflation should continue to moderate as well? Well, I suggest on the equities front that you consider those sectors that were the most beaten up in 2022 and thus stand the greatest likelihood of a significant rebound towards the second half of 2023 into 2024. Those are areas such as information technology, consumer discretionary, notably e-commerce, and even healthcare. Healthcare is often looked to as more of a defensive area, but if you consider the biotech industry, that's where the real growth can occur based upon M&A activity. So I believe if you invest in those 3 sectors that should lead the U.S. economy out of this recessionary period and have also helped lead the economy out of COVID-19, that should be some real good opportunities for growth in the years ahead.
And Kevin, some of the companies that you guys do hold right now, I understand Broadcom, Dix, and Regeneron. Yep. Let's just talk about Dix because you mentioned that consumer discretionary part of it right now. What sets them apart maybe from some of the other players within that sector? Why do you see some upside opportunity there?
Sure. And, as you know, Shauna, our country is obsessed with sports. Look no further than the recent March Madness.
I was going to say, I see the UConn sweatshirt behind your shoulder there.
Yes. my younger daughter, Brianna, is a senior at UConn. So the whole Mon household is very happy that they won the national championship on Monday night. But going back to Dix should certainly be a benefactor of that obsession with sports and the need across the country to buy sports apparel, sports equipment, and also spend money on health and wellness. Dick's has done an excellent job expanding their online footprint to complement the large number of stores that they have, brick and mortar stores across the country. Dick's pays a dividend of nearly 2%. They have positive free cash flow on their balance sheet. Their forward PE is below 11, and they have less than 50% of the debt to asset ratio. So I think they're well positioned, they're well run, and they also tap into our country's obsession with sports and health and wellness.
Certainly does. That is a strong case there for Dick's and some of the other players within that space. Kevin Mon, always great to speak with you. Thanks so much.
You as well, Shawna. Thank you.
Let's do a quick check of the markets sponsored by Tasty Trade. Again, you're looking at the Dow holding on to gains up just about 60 points. S&P and Nasdaq, though, the laggards of today's session. Taking a look at the sector action today, consumer discretionary an underperformer off almost 2%. And you're also looking at technology among the laggards as well, with the XLK off just about 1%. Well, you're just getting started here on Yahoo Finance Live. Coming up, we'll head over to the New York International Auto Show, where car makers are showcasing their latest and greatest models. Dave will be speaking with Ram Brands CEO Mike Koval Jr. and Kia America's COO Steven Center. You won't want to miss those interviews coming up. Also, investors keeping a close eye on FedEx. We're looking at gains of just about 1% right now. The company announcing an ambitious new cost-cutting strategy by combining its two main delivery networks. We will discuss what this means for FedEx, what it means for investors. Don't go anywhere. Walmart had day two of its investor day earlier today, where executives outlined plans on doubling down on growth, improving operating margins, and also returns on investment. Now, the company leadership weighing in on the state of the consumer. Brooke DePalma is here with the details. And Brooke, when you take a look at Walmart, they were able to hedge maybe the worst of it compared to some of its rivals. What are they seeing now?
Well, now they're seeing that strategy of low cost every day certainly playing a big role here, and that's how they continue to gain market share. As we saw in the latest quarter, they saw net sales up roughly 8% as they continue to gain high income households who are looking against stubborn food inflation and maybe going to Walmart as a change up in their grocery trips. Now, in an analyst Q&A today, CEO and president here in the U.S., John Furner, weighed in on trends that they're seeing right now when it comes to that U.S. consumer.
There has been some trade between brand and private brand. There have been trading down, trading over within protein categories and other things. And mix remains a concern on the business side for us. It's on the customer side, of course, we're completely focused on serving customers flexibly any way they want to be served. And we would always take strength over weakness in the economy. But we're positioned well, and we have a food business that's profitable and growing. And we'll manage mix carefully as we move throughout the year.
And as you could see there, Walmart, like many other retail giants, looking to understand that category mix as consumers continue to turn away from discretionary items like TVs and computers and towards food and perishable goods. But Walmart's saying here that inventory is, quote, better shape. They said that they've made significant progress on food and consumables. They also said that by doing that low price everyday strategy, they're able to avoid promotional markdowns and extra labor that comes with inventory surges, that is. And in addition to that, they said that omni-channel approach is quote unquote winning approach here. They continue to double down on digital. They're hoping to see double digital penetration. In addition to that, a lot of growth happening from pickup and delivery. Now that is a win for their Walmart Plus service here. But like many others, they're looking to grab attention of younger generations. Gen Z and millennials, they say, are looking for quote affordable brands. And as far as private brands go here, they account for more than 20% of sales at Walmart. They're seeing over 30% of sales of private brand sales at Sam's Club and Walmex. That's Walmart in Mexico here. And they said that out of 22 brands that they have that are worth over $1 billion in sales, that is, 8 of them is in food and consumables. And so Walmart trying to continue to gain market share here and retain those customers that perhaps traded to Walmart over the past year as inflation remained high.
All right, we'll see whether or not these plans help them do just that. Brooke, thanks so much. Let's continue talking about Walmart's Investor Day and the retailer's plans for the future. For that, we're joined by Arun Sundaram, a CFRA analyst. Arun, it's great to see you here. So Brooke just outlining some of the highlights, or from the headlines, I should say, from this Investor Day. Walmart saying that it sees a, quote, clear U.S. supply chain, also that its inventory is in better shape. We know that Walmart is obviously a consumer bellwether. What was your big takeaways from the Investor Day over the last 2 days?
Yeah, great question. Yeah, overall, we thought it was a positive and very upbeat presentation. I know our big takeaway is that I think Walmart is really entering a new phase now that the operating environment is starting to normalize. We're getting past the pandemic, supply chains are improving, inflation is coming down. So I think for Walmart, now they can focus on growing profitably and expanding margins as opposed to the grow at all costs model that it sort of deployed at the onset of the pandemic. And that's really what investors want to see. The investors want to see not just good top line growth, but also margin expansion. And during this presentation, Walmart said they're going to expand profits, grow profits at a faster pace than sales growth, meaning margin expansion. And that's largely going to come from automation, more automation within its distribution centers, more automation at its stores. It's also going to come from cutting costs in different parts of its business, and also going to come from these alternative profit streams or all these alternative businesses. Everyone knows Walmart as a core retailer, but Walmart's becoming more than just a retailer. It's becoming an advertiser. It sells data. It's doing third-party fulfillment services as its online marketplace grows. It's getting bigger in healthcare, financial services. These are much higher margin business streams than retail, and that's going to help Walmart grow its operating margins over the long term.
Aaron, your comments there on automation, that also stuck out to me because some of the estimations here, Walmart saying that they expect 65% of their stores by 2026 to be serviced by automation, a majority of their fulfillment centers. We know what you think that's going to potentially do here to margins. What is that going to do, though, to the hiring picture and what the employee headcount could potentially look like at Walmart going forward?
Yeah, interestingly, Walmart said that although they're going to deploy more automation within its stores and fulfillment centers, that it expects its headcount to be stable to slightly up, and it's also expecting wages to be up, meaning, a lot of these, lower level jobs might be cut, but, they'll redirect those employees to other jobs that require less manual labor. So they're expecting also to increase employee retention, now that, less strenuous jobs, less manual labor, and more of those higher paying jobs will be there. So interestingly enough, they do expect have a stable headcount or slightly higher headcount, even though they're deploying all this automation.
Arun, how big of a factor are labor costs right now? Is that still a pressure point here for Walmart?
Yeah, that's been a pressure point for several years, and it's going to be another pressure point for this year. It was just a few months ago, Walmart announced that they're increasing wages for their U.S. associates this year. I believe the average hourly wage will now be over $17.50, and the minimum wage is now $14 an hour for their store employees. And they're also increasing benefits for their store employees, things like expanded healthcare coverage, tuition reimbursement, things like that. But I think the good news is that, although wage pressures continue to exist, it's probably going to be less of a headwind this year than it was the past few years. I think that it's slowly becoming less of a headwind, but albeit, it still is a headwind.
Arun, what's the one thing that you think Walmart needs to do to succeed and help maybe widen that gap or at least stay ahead of some of its rivals out there?
Yeah, I think it's really about it becoming a true omni-channel retailer. Many people still only shop inside Walmart stores, inside their physical stores. But now they're really, doubling down on both their in-store business and their online business. For their online business, they don't want to be just a first-party marketplace. They also want to be a large third-party marketplace, similar to an Amazon. And they're really trying to, they're kind of copying Amazon's playbook in that regard and trying to expand their online marketplace. They also introduced a subscription-based program called Walmart Plus. They're trying to attract more higher income affluent customers to that subscription model, similar to Amazon's Prime model. And I think as they grow this online marketplace, that'll bode well for both their in-store sales, their online sales, and also these alternative profit streams that I was talking about before. The more sellers they attract to their online business, the more buyers they attract to their online business, then the more likely advertisers are going to want to advertise on Walmart.com. And that's a way I think they're going to grow margins over the long term.
Arun Sundaram, always great to have you. CFRA, thanks so much. Walmart shares up just about 1.5% on the day. All right, well, coming up, the road ahead for Kia. We will head back over to the Javits Center, where our very own Dave Briggs will be speaking with Kia America's COO Steven Center on the company's EV strategy. What's next here for the automaker? Stick with us.
Welcome back to the New York International Auto show. Right here behind me is the beautiful blue Kia EV9, just debuted a couple of hours ago. And next to me here is Steve Center, Kia America COO and Executive Vice President. Steve, good to see you. I want to talk about this in just a moment. But first, congrats on the record Q1 sales. What was the catalyst?
Thank you. A lot of things came into place all at once. We had inventory, which is a big deal these days. We've got demand and products like this.
Big supply chain issues, chip shortages for all the manufacturers for the last couple of years. How clear are they now?
They're clearing up. There's still a lot of hiccups here and there. One of the benefits has been that the inventories have been tight, so the business is robust and everybody's doing well with it.
Of course, the headline today is this car behind me. It's the Kia EV9 that Edmunds earlier today told me is a potential game changer in the category. Why do you agree with that characterization?
It's blue ocean. Where this car is going to swim, there's nothing there. It's a 3-row EV SUV. There's nothing out there like that right now, and there won't be for some time.
Why? What is the moat? What is the differentiator?
Well, it's the size of the car, and again, the 3 rows and the EV. This is really just the beginning of the EV business, so all the different segments are starting to get filled out. And we went from EV6, which is sporty midsize, to full-size SUV, 7-passenger.
Brilliant. A lot of people out there wondering when I can get my hands on that and what it'll cost me. What can you tell us?
Later this year, and a little more than a Telluride.
Which is somewhere in the mid-50s, I presume.
60s and above.
Okay, we pried enough out of you around $60,000. So the big question when it comes to price is, anywhere in the EV space, when Elon Musk and Tesla cuts prices, does everyone have to follow?
No, we're not competing with them, and he has nothing like this and has no plans for anything like this.
You're not competing with them. Who do you eye as your most direct competitor?
Right now, there isn't anything in this class. There's a Rivian, but that's really a very expensive, very small production model.
With some considerable production issues, right. Mind you, we should mention, you guys laid out some very ambitious EV goals at your Investor Day. What are they?
Well, we want to be a sustainable mobility company. We just announced a new factory in Georgia to build batteries and to build electric vehicles here in the United States, and we're going to fill out the whole EV line side of the business.
And how much do you plan on ramping up capacity and production?
As quickly as humanly possible.
What are the biggest obstacles in getting there?
Well, there's a couple of challenges. One is really still the infrastructure. While the charging infrastructure is immature, you need something of a Manhattan Project effort to really make this transition. Because you can legislate and tell the automakers to build EVs, and they're doing that, and we're doing that. You have to have the fueling supply available. And the utilities have to come along, and the charging infrastructure has to be in place. So we have a long way to go.
What about the consumer? What are they telling you in terms of their hesitation to make that leap into an EV?
Yeah, it's the comfort with the fueling infrastructure. The technology of the car they're not afraid of. This car can charge from 10 to 80% in 25 minutes. So that's not the challenge. But having the fast charging in place for people where they are locally is the challenge.
Quickly, the tax incentives were changed because built in North America is the theme of the Inflation Reduction Act. How did that impact sales?
Well, it's going to hurt sales for people that want to buy the car, but there's a dirty little secret. A lot of people that buy expensive cars and are wealthier tend to lease cars, so the incentives are available on the leasing side. But at the same time, a lot of wealthier people that buy EVs like this one will max out on their income for the rebates. So,
nice pro tip.
Yeah.
Appreciate that. He's Steve Center, Kia America COO. He says lease. We'll be right back after a short break.
Let's do a quick check of the markets sponsored by Tasty Trade. Once again, you're looking at a mixed picture. Nasdaq, the underperformer in today's action, off just about 1%. Investors assessing the latest data that we're getting out of the jobs market, what we could expect ahead of Friday's big print, and whether or not we're starting to see some signs that the jobs market is cooling. And then, of course, the question is what this means in terms of a risk of a recession. So we're seeing some of those recession-tied stocks. When we talk about technology, chip stocks, the underperformers in the markets today. The S&P off just about 0.3%. But as of right now, the Dow is holding on to gains. Time for Triple Play. 3 stocks that we're watching in the final 30 minutes. We've got Sweet Green, Boston Beer, and Apple. Let's kick it off with Sweet Green. We're seeing a big move in the stock today. Shares are sliding. The biggest intraday drop that we have seen in months. You're looking at a loss right now of just about 8%, so pairing some of its earlier losses. Now the move lower coming after Chipotle filed a lawsuit against the salad chain. Now, Chipotle claiming that Sweet Green's Chipotle Chicken Burrito Bowl infringes on its trademark. According to the complaint, the bowl will likely confuse customers because it copies Chipotle's branding. A representative for Chipotle told Yahoo Finance that we will take appropriate actions whenever necessary to protect our rights and our brand. I took a little bit of issue with Sweet Green doing it because I would be one of those customers that would get a little confused. I would think that maybe there is some sort of partnership there. What do you think?
Well, we did reach out to Sweet Green for a response, and I do want to read this. They said that the company cannot comment on pending litigation, but it is in fact aware of the lawsuit that Chipotle has placed against its name. They also added that it remains excited about their new warm bowl featuring that thoughtfully sourced Chipotle powder that provides a slight spice. Now, I do want to note here that Chipotle recently introduced a spicy option, which they also noted provides a slightly smoky notes there. For Mesa, they also recently introduced. An analyst at the time of Chipotle's concept for Mesa launch said that they compare it to a premium option like a Sweet Green. So certainly a battle going on here.
Chipotle is a Mexican spice.
Yes.
At its core,
Yes.
right? Chipotle is a literal spice that goes on food.
Right.
Mm-hmm.
People have the right to call any kind of food Chipotle X. And I understand that it looks like the burrito bowl.
You could say a chicken burrito bowl with Chipotle, which is one of the options that was put forward from Chipotle.
There are plenty of Mexican restaurants, plenty of delis where you can get a Chipotle chicken wrap, and you know what you're getting. It has the Chipotle sauce on it. I think at some point people have to be able to use that name. So I'm interested to see how the lawsuit plays out.
Right.
I think there's a lot of similarities, though.
A lot of similarities.
A lot of similarities.
Yes.
You can at least agree to that.
Right. And then we'll have to go and we'll do a taste test and we'll see which one tastes better, and that will be the ultimate winner.
Ooh, that'll be lots of determination. Well, from spice to sizzle, let's talk hard seltzer. I'm taking a closer look at Boston Beer Company, ticker SAM. In a note from Guggenheim, it seems that traditional hard seltzer category is in fact losing its sizzle. Boston Beer's truly hard seltzers in part driving that decline. Sales down 28.2% in the last month. That's compared to White Claw up 0.3%. Bud Light seltzer sales also down 50.2%. Now, on the other hand, the ready-to-drink category is getting a boost here. Boston Beer Company Twisted Tea sales up 31%, but that's far behind top competitor High Noon with sales up 94.4%. Now, the launch of its tequila offering contributing to that 28% of that growth. The Boston Beer Company also produces Hard Mountain Dew, which has seen a slowdown in sales compared to a year ago, but shares of Boston Beer Company down 19% from a year ago. Now, I also want to note that ready-to-drink sales are just gaining share. We saw Jack Daniels and Coke introduce something last week. In addition to that, AB InBev's Neutral, they launched a national campaign. It's their first one. That's the vodka hard seltzer brand. And so certainly seeing a pivot here when it comes to consumer preferences.
And we've been seeing this. I'm just shocked that Sam Adams didn't catch on to this quicker. When you saw High Noon sort of take off, right?
Back in 2021,
yeah,
this
and
is
it's
when
a
hard
vodka
seltzers,
mix.
right.
Instead of the malt liquor, and it's become more popular. I'm just shocked that these brands weren't quicker to get to tequila and let High Noon beat them there.
Right. Yeah, and I think that's largely been the criticism here when it comes to Boston Beer, the lack of innovation, the lack of really being able to capitalize on some of the partnerships that they did have with distribution, why they weren't able to really expand some of their sales growth when it does come to Truly. In terms of the hard seltzer category, though, I wonder whether or not we've really seen the extension of that growth, because you have to wonder, people aren't talking about it nearly as much. The growth numbers have come down pretty sequentially here over the last several months, the last several quarters. And we know that Boston Beer has been slowly losing its grip on that market share. Can't cut them out. They could always come out with something else, but you got to question why it's taken them so long to do so.
Yeah. Well, let's stick with an innovative company. Right? We'll go over to Apple on a new note from Bank of America highlighting highlighting improving trends in both iPhones and services as a potential upside to drive margins. Now, B of A boosting its price target to $186 a share and maintaining a neutral rating on the stock. The bank writing in a note to clients that positive catalysts for Apple, including the potential launch of its AR headset later this year, could still be offset by a consumer slowdown in the second half of the year. Another interesting part of this note, I want to point out two charts. One shows global App Store revenue by month, according to B of A, and this is compared year over year. You can see it just turned up for the first time in about a year in March. But when you take a look at China, you see a different story. You can see App Store revenue still continuing to decline year over year. And I think that sort of speaks to where things are at with China, still struggling, things are at with Apple, still struggling in China a bit more in other areas. I thought those two graphs kind of tell that story.
We'll see how long the recovery could potentially take if we do see more of a recovery there. But when you take a look at its services business, that install base, that has certainly been a massive catalyst for services. They have 2 billion devices globally. And so they are starting to see this more and more traction when it comes to services. One of the areas that a number of analysts were very bullish on after that weaker than expected iPhone number that we got last quarter. You're right to point out the App Store and what that could mean, especially over in China, really just given the importance of that region and what that really means for Apple's overall growth.
Right. Now, Dan Ives, an analyst that comes on our show often, he did say that we estimate roughly 25% of the current iPhone installed base has not upgraded their iPhone in 4+ years. And so Apple certainly spreading its tentacles far here, sort of just the amount of opportunity that it still has is pretty incredible. Us three all have iPhones on set right now.
Yeah.
Part of that 25% is sitting right here.
Exactly. And the battery is going quicker and quicker, so I'm going to need to fork over that $1,000 to Apple pretty soon. All right, well, coming up, FedEx announcing a massive restructure of its delivery networks to stock trading higher on the news, up just about 1.5%. We've got analyst reaction for you after the break. FedEx, it is a trending ticker on Yahoo Finance today. You're looking at shares up just over 1.5%. The delivery giant announcing a massive restructure, planning to combine its ground and express delivery networks. Here to break all of this down is Anthony DeRuyter. He's Third Bridge senior analyst. Anthony, it's great to see you again here. So certainly from the stock's reaction, up just around 1.5%. So I guess you can say investors are a bit excited about it. What do you think?
Thanks so much for having me again, guys. For sure, the stock's up a little bit less than where it was pre-market, by the way. But, for an event that was designed to, I guess, settle uncertainties about their execution strategy with Drive, with Network 2.0. The event actually raised a lot of questions, at least for us over at Third Bridge, namely, how realistic are these about $6 billion, $4 billion in Drive, $2 billion in Network 2.0, $6 billion in cost savings, these opportunities, how realistic are they? How realistic is network integration for FedEx, given their history of segmentation? What sort of risks do they open themselves up to with network integration? And what does it mean for them competitively in the near term? So, if we're going to nitpick how realistic these cost savings are, like if we take the 700 million that they're targeting over in Express for their air fleet, last time I was talking to you guys, we talked about how minimum flying hours, pilot pushback, those would be very real risks for the company in executing there. Well, the pilots are picketing outside the event. That's what I saw last time regarding what happened today over at the Drive event. The overall direction of them wanting to densify, sort of optimize, cut, and be more efficient here and there, definitely a step in the right direction, but the language points to capacity cutting. So 30% reduction in trans-Pacific frequencies. That's a high yield route. You might be giving up some yield there, is what our experts are telling us, if you give up capacity on the trans-Pacific. They want to use third-party lift. They've tried it before. There's major cultural differences in moving from sort of hub and spoke to point and using third party. So you're essentially telling them, look, stop what you've been doing since the start and now completely overhaul everything. So there's a cultural wall there, if you will. And if you're going to take capacity out, well, we talked about that last time. How are you going to convince the pilots who are pushing back? How are you going to take capacity out of the fleet without putting, air slots and landing rights at risk? And then just things like, for example, if it's not about cost, if it's about improving the yield and the margin profile, they say they want to target SMB. Bree was really, she was quite confident that they would gain share in SMB, but that is a segment where they're typically and historically less competitive than UPS, because UPS can play around with their more efficient cost structure and better service thus far. Plus, overall, last thing I'd say there is just FedEx was very contradictory with their language. Like, they talked about Sunday deliveries and how that's a key comparative advantage for them there, but at the same time, they announced that they wanted to pull that back before.
So, Anthony, fair to say that you're a little bit skeptical about a number of the announcements that did come out from FedEx today. Let's talk, because there was a lot to break down in what you just said. You brought up the cultural challenges. You brought up questions just in terms of how much FedEx is going to actually be able to cut costs by. What about just the timeline of this? When you talk about the scale of this transition, do you have any sense in how long something like this is going to take?
Yeah, so I mean, the timeline that they've talked about, sort of all this realized by somewhere in fiscal 2027. The sort of, let's call it near to medium term timeframe, the sort of 2 to 3 year timeframe there. You're talking about a complete overhaul of the network, and if they're going to do this quote unquote right, our experts are saying, again, no ground, no express, just one network. That means subjecting themselves to potentially different labor relations regulations, and we can talk about that later. But it's a very quick time frame, and when we talk about how realistic integration is, when that question was posed today at the event, Raj had Sriram answer, and Sriram said basically, look, you've got 450 initiatives as part of Drive, each of them with their own milestones, their own paths, their own financial values, their own investment requirements. And Raj actually has his sort of finger on the pulse of how everyone's doing and whether certain pods are struggling with delivering on initiatives. That's how they sold it to investors over at this event. Now, if you have 450 different initiatives and they're all sort of competing for the same internal resources, that seems to us more like siloization as opposed to de-siloization, which is what network integration would be. So 3 years might be a stretch, but that obviously is crystal balling.
Well, Anthony, let me ask you this, because when you take FedEx, a lot of people obviously compare it to UPS, the other massive giant out there. How does this transition, what the restructuring is going to look like at FedEx, how does that compare to what's currently in place at UPS?
All right, so actually that is a big question. And the best way to talk about this is to first talk about what network integration means vis-a-vis how FedEx will look relative to UPS. So what actually happened during the event is you had an analyst bring up, if you integrate your networks and become one entity, how do you stop your company then coming under or guaranteeing that it continues to come under the Railway Labor Act? Because UPS is under the NLRA regulations, and that has, well, it's given them the ability to sort of have this one network that gives all these density and efficiency benefits that they have over FedEx historically. But at the same time, they now have a Teamster contract renegotiation this year, which is posing quite a bit of a risk. So if FedEx does successfully and truly integrate their network into one, put Ground Express together, you're one entity, and you look more like UPS, yeah, you might have those benefits from a sort of a density and operational standpoint, but now you expose yourself to some of the risks that we see with UPS, which is union risk, strike risk, less flexibility over your labor.
Yeah, getting back to some of those labor questions there. Anthony DeRuyter, always great to get your perspective. Thanks so much for joining us. Well, the judge overseeing former President Trump's case issued a warning to the former president. Now, the justice there, according to the New York Times, telling Trump's lawyers to speak to Trump and those in his circle and tell them to, quote, refrain from making statements that are likely to incite violence or civil unrest. The judge, however, stopped short of issuing a gag order. But will Trump be able to contain himself? To discuss, I want to bring in Yahoo Finance, a senior columnist, Rick Newman. So, Rick, let's talk about this, because what we heard from Trump after that last night in a speech from Florida, he really seemed to resort to his old habits. So it doesn't seem like he's going to be able to really hold back much.
Oh, he railed against everybody last night, not just the prosecutors who have now filed these short charges in New York and the judge overseeing the case. He went after prosecutors who haven't even filed any charges against him yet, including the Fulton County District Attorney in Georgia and the federal special prosecutor who's looking into obstruction of justice. So Trump realizes that this web of legal investigations is tightening around him, and he's just attacking everybody. He called the federal prosecutor, Jack Smith, a lunatic. I mean, how far does he really want to go with this? He's basically taunting prosecutors who are now bringing muscular cases to court, including some cases that'll probably be more serious and more threatening to Trump than what we've seen in New York. So it's quite fascinating. I mean, he obviously thinks he wins every time he takes on authority. And I suppose he does win against his base. But my contention is that Trump is just turning off everybody else in the country except for his base. And I think it's becoming impossible for him to win a general election where he has to get some moderate voters and some swing voters. And I think it's going to get worse because his legal problems are going to get worse.
Yeah, Rick, to that point there, in terms of what we heard from the president last night, he was lashing out at everyone. We didn't really hear anything at all in terms of a 2024 campaign, what he wants to change, any sort of policies, what he would do to fight some of the inflation pressures, the cost issues that we are facing today.
Absolutely right. So if you support Trump for president in 2024, all you're going to hear about for the next almost 2 years is all of these prosecutions against Trump. And I realize at this point there's only one, but there are likely to be at least one or two other ones. And this litigation is going to go on throughout the presidential campaign in 2024. So Trump is going to be quite busy. He's not going to be having, policy meetings with experts and trying to develop campaign themes that stick and figure out how to counter Biden policies and stuff like this. He's going to be spending all of his time in court, strategizing about going to court, and then complaining about being in court. So if you're a Trump supporter in 2024, it means your whole universe is just going to become these lawsuits and prosecutions. And I would add that the next one coming up within a couple of weeks involves rape and defamation charges by the writer E. Jean Carroll. So I mean, how are they going to celebrate this one down at Mar-a-Lago if that doesn't go his way? It just gets more sordid and more complicated for Trump. And it's hard for me to imagine, aside from his base voters, why anybody would stick with him at this point.
I agree with you. It certainly could get much, much more complicated for him and his base. Rick Newman, thanks so much.
See ya.
We are counting down the final minutes of the trading day. Again, the Dow holding on to gains just above the flat line, up just about 86 points. We'll be right back. We are just 2 minutes away from the closing bell. Jared Blickery has a closer look at some of the movers today. And Jared, there's plenty of red there on your screen, unfortunately.
Yes, the Dow is an exception. That's in the green, but just barely by about 0.25%. Nasdaq down 1%, down about 2.5% for the week. Let's take a look inside the market. According to the sectors, and some of them are green. Yes, utilities up 2.5%, but followed by healthcare, staples, and also energy. Rather a defensive setup here. The biggest loser, consumer discretionary, that's retail, followed by industrials and tech. All of these down by more than 1% here. And just taking a look inside the Nasdaq 100, some stands out. First of all, everything to the left, the mega caps all in the red. Tesla down 3.5%. Are seeing some green in the staples and healthcare. That's kind of what I was just mentioning there. AstraZeneca, healthcare stock, that's up 2.5%. PepsiCo up 1%. But check this out. China not doing very well. You take a look at the ARC components, disruption not doing very well. This market is bleeding from the edges. And we were taking a look at the regional banks earlier, specifically WAL, Western Alliance Bancorp, as kind of a bellwether. And here's what it did intraday, down 12%. I was saying this might be a reflection of the broader market, that financials are in the process of taking another leg down, and WAL is just leading the way. We'll have to see what comes of that. In terms of our leaders here, looks like we got a few seconds to go. ARC, I just mentioned that. That's down 3.5%. Meme stocks not performing well. Neither are IPOs. All of those down more than 3%, Shona.
All right, well, that does it for today's market action. Let's get a quick check of where the market settled, sponsored by Tasty Trade. Again, you're looking at a mixed picture. It was certainly a defensive-driven day, like Jared was just saying. The Dow closing just barely in positive territory, up just about 80 points as we shake out the final trades. S&P and Nasdaq, though, the laggards of today's session. Look at the Nasdaq off just about 1%. That move lower coming as a number of the larger tech giants, some of the chip names underperformed in today's trading action. All right, well, let's get back to one of the big stories of the day. We are back covering the New York International Auto Show. Dave Briggs has, and he's been doing it all day for us on the floor down there. And Dave, what are you inside now, a Wrangler?
I am in a Jeep Wrangler. It's the 4xe, and I love this car. The problem is you can't get your hand on one, Shauna. Everyone's paying a premium for Jeep Wranglers. I think it's part of two themes happening in our economy. One, of course, is the electrification of our cars, and that's what the 4xe satisfies. But the other one is our desire to get out there and live and get dirty and travel, let the wind blow through our hair. And so what you're seeing is people are paying 24% over manufactured suggested retail price for the Jeep Wrangler and 22% for the Wrangler Unlimited. That's two of the top 5 cars in the country that people are paying a premium for. Dealers tell me you can't keep them on the lot. It's that desire that all of us have to get out there and experience life coming out of COVID. It's a beautiful car. Big fan of it.
It certainly is a very, very beautiful car. I was on the floor earlier today, and I saw a quick peek of it. I'm jealous that you just got to jump in because I was reading about the Wrangler today and a lot of the excitement there about the redesigned interior. Dave, also, what about Ford? Because when we talk about Ford, there are some questions about whether or not they might be losing some of their edge when it comes to EVs. We saw GM overtake Ford in the latest sales data out in the EV space. What did you learn there?
Well, it's interesting to see Ford's EV sales are up 41%, but that forced them to slip actually from the number 2 spot as Chevy overtook them. I think really they had a couple of production issues, some supply chain issues. They had the fire regarding the Ford F-150 Lightning. I think they're going to be just fine because they've got a really wide variety of EVs hitting the market. And in particular, that Ford F-150 Lightning is extraordinarily popular. But they also say, pump the brakes a little bit. People still love some muscles. And one of the cars they have here on the floor that people are flocking to see is the Mustang Dark Horse. And it is the ultimate muscle car, 5-liter V8. And they designed the inside to feel like a cockpit, a performance cockpit. Almost feels like you're in a fighter plane. It's a really unique, strong car. I talked to actually Boomer Esiason, the former MVP quarterback of the Cincinnati Bengals, a 4-time Pro Bowler. He was here at the auto show. He's actually a Ford rep. And he said, look, I prefer these gas-guzzling cars still. He likes the Mustang. He says, I'm hesitant to really make the jump into the EV space, and here's why.
I'm a Raptor owner, and I'm also a Bronco First Edition owner. So I like my trucks with big engines. I like the gas-driven trucks, and I have to tell you that I'm still not all in on the EVs yet, although I will say the Lightning and the Mach-E are rocket ships in their own right. The thing I have to get used to is how quiet they are. I'm just not used to the quiet nature of the EV just yet.
What will it take to get you in an EV? I'm hesitant too. I'm not ready.
You know, I think what it's going to take, it's going to have to have the same feel as the truck that I'm driving now.
And I think he represents really the consumer right now. There is growth, a lot of it. In fact, doubled the market share in 2022, but we're still talking about around 6 or 7% market penetration for EVs. There's a lot of hesitation for many reasons. Of course, affordability is one, but there's a lot of other issues. It's that trust factor. I think the biggest factor that you're seeing when I talk to people here who are hesitant, it's the charging capacity, it's the infrastructure, it's the fear that they're going to be driving somewhere with their family and the car is going to run out of charge. Once they overcome that hurdle, I think the game really changes, but we're a long way from that, Shauna.
We certainly are. And I like what he said there just about when you get inside an EV. And I thought this today, it was the first time I had ever been inside an EV. It was so quiet. I took a ride in the IXIC, which was just awarded the 2023 World Car of the Year. And I was shocked. I didn't even know it was on. I asked the guy, I was like, can you please turn it on? He was like, oh, It's running. We're good to go. We can go anytime. But Dave, great stuff.
Yeah, and it's almost uncomfortable at first. Yeah,
it certainly is. It can throw you for a loop. I'd probably leave it on and forget that it's running. All right, Dave, we'll check in with you in just a few minutes. We want to get back here to the market, some of the economic data that we got out today. ADP's jobs report showing that private employers added 145,000 jobs in March, coming in below what the street had expected. Joining us now for what this could potentially mean for the economy, for the labor market, we want to bring in Matthew Lazzetti. He's Deutsche Bank Securities Chief U.S. Economist. Matt, it's good to see you again. So some signs here that maybe the jobs market is starting to cool. How are you looking at the data that we got out over the last 2 days and what that could signal for Friday's jobs report?
Yeah, I think the data that we've seen over the past several days and over the past week have really all surprised to the downside. You mentioned ADP this morning. We've seen the ISM manufacturing and services indices both surprising to the downside. We had the JOLTS data, which shows job openings, which were materially below expectations. Today, it wasn't really followed very closely, but the BEA has high frequency data on card spending for consumers, which also has slowed materially. So I think we have an economy that very clearly looks like it's slowing. The labor market, I would say, is still very, very resilient. The uncertainty is how much of this is give back from very strong data during January and February, which was in part boosted by the weather. But I think at the moment, there's a lot of uncertainty about that. I think what we do know is the labor market does remain resilient. It does remain tight, but the overall economy is certainly slowing.
And when we talk about the overall economy right now slowing, to what extent do you think we're going to see, could we still see the Fed get inflation under control without triggering a recession? Is that still in the cards?
So on our base case, it's not. We still expect a recession this year. Ultimately, we've always thought it was the second half of the year story. Our baseline is that it begins in Q4. I think really assessing that, the key question has become what happens with credit conditions and bank lending conditions after recent volatility that we've seen. Certainly that should add to tighter financial conditions. I think it should add to the slowdown in growth that we see over the next several quarters. The key question has been how much tightening are we going to see? What is the magnitude of the impact on growth? We think, at least it could subtract 40 to 50 basis points from growth over the next several quarters, which for us points to a recession risk that's a bit earlier than our baseline.
Well, Matt, let's talk about how much more hiking we could potentially see, how much more restrictive policy could get. What's your base case there, and what do you think could potentially happen, even if the Fed is forced to raise rates maybe more than we are forecasting right now?
Yeah, our baseline is that they raise rates again in May by 25 basis points. That would bring the Fed funds rate up to 5.1%. And that's essentially what they told us 2 weeks ago as part of their dot plot or projections. But they've also told us that they're highly data dependent. Whether or not they raise rates in May and then beyond will depend first and foremost on what they're seeing in the data, the labor market and inflation data. We'll get the jobs report this Friday, which we expect to remain sturdy, but we'll get a very important CPI report next week, which will be, I think, a key determinant for whether or not they raise rates again at the May meeting. And then there's also this overhang of what's happening within the banking sector and credit conditions. And do we get any negative evidence there, or do we get evidence that is really feeding through into a sharper slowdown in the economic data? So the Fed will be looking at all this. At the moment, we expect that they raise rates for the last time in May by 25 basis points.
Matt, what is your assessment just in terms of the turmoil and everything that has been going on within the banking sector? Is the worst of it behind us? Because even Jamie Dimon in his annual letter was saying that the repercussions from the collapse could be for years to come.
Yeah, I think over the past few weeks, we've certainly seen some greater stability. We've seen greater calm in the markets. When you look at the Fed's lending facilities, there's been a less take-up over the past several weeks. When you look at bank deposits, they've been declining over the past year, but there's been some stability over there in recent weeks. And so I think we have reached a period where, at least for the time being, it looks like there's been greater stability on the banking front. There's a related question, though, is what are the knock-on effects to lending conditions that we see over the coming weeks and months and quarters? And that's where we think that there is going to be a meaningful impact on growth. And that'll be banks tightening their standards on commercial and industrial loans to businesses, to CRE, commercial real estate loans. And then that will drive a slowdown in the economy, particularly in the second half of the year.
Matt, what's your reading just about what's going on in housing? I mean, that is one area of the economy where we certainly have seen a significant slowdown. Is it going to get even worse, or is the worst of the housing pullback behind us?
So we think that part, the worst of the pullback is behind us. I mean, residential investment has contracted by about 25% annualized in recent quarters, which is a very, very sharp slowdown. And it's the one area where the Fed's tightening cycle was transmitted very quickly to the economy through higher mortgage rates, activity in terms of purchases, and then housing starts. We expect that it's going to contract over the course of this year. It is typically a cyclical sector. So as the overall economy slows and then moves into contraction, you would expect residential investment to be there too, the housing market to be there too. But we do think that to a certain extent, the worst is behind us because we've gone through a material contraction already. And perhaps we have seen the highs in mortgage rates, which should be at the margin at least helpful.
Matthew, circling all the way back to where we started this segment, talking about jobs right now, talking about the labor market. We get the jobs report on Friday. What do you expect that print to be?
At the moment, we expect to be 250,000 jobs, which is below the 3-month average, below the 6-month average. So it is slowing, but it's still an economy that is adding a meaningful amount of jobs. We expect the unemployment rate to be 3.6%. And if we get that, it's an economy that still looks tight from a historical perspective. We mentioned the JOLTS data earlier in the week in terms of job openings coming down. Despite that, you still have 4 million more job openings than unemployed individuals. The quits rate has actually moved higher. And so I think the overall messaging from the labor market is certainly it's one that's slowing, but it's still historically tight.
All right, Matthew Lazzetti, always great to get your perspective. Deutsche Bank chief U.S. economist, thanks so much for joining. Coming up, Ram brand CEO Mike Koval Jr. fills us in on his company's game plan for electrifying its trucks. Stick around.
All right, back here live at the New York International Auto Show, where EVs are, of course, the theme. But don't for one second think that doesn't mean power. Mike Koval Jr. is the Ram brand CEO. He's here to tell us about this powerful, big, beautiful Ram 1500 Rev. Again, there's some hesitation among pickup truck lovers that it doesn't have the power they need. Does this?
It sure does. And that's the one thing that our customers demanded of us. And they said, Mike, we'll come along for the ride with you. We're hesitant, we're nervous, but do not compromise on the core attributes that we care about the most, which historically has been towing and payload, but more importantly is about charge time and range in the future. And Ram will offer a better suite of solutions, which is what we announced today.
Okay, first let's start with the towing capacity, because that's what I hear from pickup truck drivers all the time. How's it compare?
Up to 14,000 pounds of towing capability. That's actually more than my ICE equipped versions. 2,700 pounds of payload. And we also, in terms of range, we offer a 168 standard kilowatt hour battery, which affords you up to 350 miles of range. But if range is really your primary purchase reason, you can opt up for the 229 kilowatt hour battery pack, which affords you up to 500 miles.
And that appears to be the real moat, if you will, between this and its nearest competitors.
Yeah, that's what we've heard. We've heard that a lot of range anxiety, especially while towing, and we think Ram has been able to push past what our competitors have announced today. But I will tell you this, as good as these numbers are, we're not done yet. We also confirmed today that we will, shortly after the Ram 1500 Revolution launches next year, we're going to introduce a Ram 1500 Rev XR for extended range version, which will offer even more class-shattering range than what we've revealed today on the pure battery electric model.
You care to tell us what that range is?
I would love to, and I will do so very soon.
Okay, what about sticker price for the Rev 1500?
A little bit closer to when we get on to when we start production. But suffice it to say, like you, I'm a consumer as well. There's a big elephant in the room. The cost of electrification is very real. But in my view, in my humble opinion, if we're not creating electrification that's available to the masses, I'm not really sure what we're doing. So that's I'm very cognizant of that, and it's top of mind, and we're working very hard to get as much cost out of the system. And the good news is, a little too much economic news for you, but honestly, we are starting to see a little bit of relief in some of the materials that are going into the product, which is good news. And I think just like any new tech, it'll start high and it'll come down over time, and we're starting to see some of that.
Okay, so range and power are the lead, but I'll be honest, Mike, my biggest surprise was opening up the doors, seeing the interior, and in fact, sitting in the back seat, I'm 6'2", had no problem fitting back there. What was your priority when it comes to the interior of the car?
Well, not to abandon what's already worked well for Ram. If you think about Ram trucks, one of the things we're known for is our interiors. Not only the luxuriousness, but also the practicality. So we like to say we have back seats that do front seat things. They're heated, they're air conditioned, they recline. But everything that our customers have come to know and love from Ram, imagine that now electrified. And that's what we have here today.
Another theme that we're seeing throughout the show is tech. And the screens are unlike anything I've ever seen. What'd you do in there?
Yeah, so first of all, part of the reveal today was to also introduce a new top-of-the-line trim. This is called the tungsten trim level. So what we bring in with the tungsten trim level is an all-new 12.3-inch digital cluster, a 14.5-inch screen in the stack. Now, you may remember,
14.5
well,
inch.
when we introduced the most current generation back in 2019, that 12-inch was class-shattering, never been done before. Now it's table stakes. This is 14.5. But what we've done is we've introduced a passenger side screen, 10.25 inches. So then now you've got a co-pilot that can navigate with you, or basically use the screen as an extension of their cell phone. So it's really a no-compromise, neat, innovative, tech-forward solution from Ram.
So my wife can yell at me that I'm going the wrong way on the display right in front of her. Thanks a lot for that, Mike.
We're trying to help.
I appreciate that. All right, biggest obstacle between mass adoption for EVs like this across the country as we get beyond 6 or 7% market penetration. How do we get there?
Yeah, so it's going to be gradual, right? And I think especially because trucks still need to do truck things. They need to tow, they need to haul. That's the one thing, as I mentioned, that please don't compromise. Electrification cannot be a limitation, okay? And so provided we stay true to those roots, we will bring our customers along with us on this journey. I don't expect this to change overnight, but I will say, if you look at the adoption projection through the end of the decade, our internal projection is actually more bullish than that, believe it or not. So we're all in, and I think the Ram 1500 Rev is the first signal that Ram is in.
It's middle America that buys the most pickup trucks, which is probably where the weak spot is in terms of charging infrastructure. How fast is that changing, and how far do we have to go?
I think for sure it's still an issue, but if you think about how far we've come in such a short period of time, now you have private money. I think you're going to see incremental leaps and bounds with respect to the infrastructure, charging infrastructure across the country, not just in major cities, but across the country. So I think we're going to get there faster than you think. For sure, it's a concern. We're working on it with many of our partners as well to help make things a little bit, I would say, less friction.
Yeah.
That's what we're trying to remove, because there's a lot of concern about range out there. But I think you're going to find that it's going to rapidly improve.
I've never taken the plunge into an EV, but a pickup like this, I think just might do it, Mike. Good to see you, sir.
Good to see you.
Thanks so much, Mike Koval Jr., Ram brand CEO. We'll be right back after a short break.
The buzz at the New York Auto Show is all about what's next in EVs, and Hyundai is expanding its footprint in this space, unveiling an all-new Kona EV. I caught up with Randy Parker, Hyundai America's CEO, about that all-new Kona, as well as their popular IXIC models, including the IXIC, the 2023 World Car of the Year winner. Here's what Randy had to say about that.
We're off to a terrific start at the New York International Auto Show. Because of the all-new IXIC, we won EV Car of the Year, we won Design Car of the Year, and we also won World Car of the Year. So an impressive start, and you're absolutely right. So we are launching the all-new IXIC, just went on sale last month. We're also launching the all-new Kona EV, which we just highlighted to the press, and we also we're launching the Disney Platinum 100 edition with our partnership through Disney. So a very special day for Hyundai in New York.
Tell us about that partnership with Disney. Why does that make sense? What do you think that will really do for awareness of EVs?
Well, you know, co-branding with a brand like Disney is something that we really look forward to. I mean, who doesn't like Disney, right? I mean, Disney is by far the happiest place on earth, and it's been a great partnership so far. And what's really cool about the IXIC Disney Platinum Edition is that our designers worked hand in glove with their engineers to help produce the cars. So if you're out at the International Auto Show, come out and check out the Disney Edition. I think you're going to love it, especially for those people who love Disney.
One of the things when we talk about electric vehicles, EV, is widespread adoption. What do you think is really necessary in order to convert some of those buyers out there who are a little bit hesitant right now to purchase their first EV?
Well, you know, a great stepping stone for EV would be to take a look at a hybrid. Because I know a lot of people are very concerned about range. The IXIC has a range of 361 miles, which I think is pretty impressive. But if you're not quite sure that you want to get into an EV, a good stepping stone would be to get into a hybrid vehicle and then slowly transition into an EV. The second thing I would say in terms of adoption is that in the United States, we've got to improve the infrastructure. I myself drive an electric car. I've got a level 2 charger in my garage, and I got to tell you, I don't think I'll ever go back to driving a internal combustion engine vehicle. But I know for some people it's a little bit of a concern because of range anxiety. But once you step into an EV, I don't think you'll ever go back to a gasoline car again.
And Randy, pricing is another thing that's brought up a lot in terms of widespread adoption, what's needed, lower pricing on EVs. We've got the IXIC right here, and I believe that's just over $40,000. How do you see Hyundai, or do you see Hyundai as a player here in the cheaper EVs, anything below $30,000 possibly?
Well, you know, the Kona EV will get you closer to that price point, right? There's some other things that we're looking at that I can't disclose this morning. But the good thing about the Hyundai brand is that our goal is to try and create a seat for every purse. And we've got a wide range of EV vehicles that consumers can choose from at different price points. But soon we may be making some additional announcements.
And Randy, when we talk about one of the reasons why electric vehicles, EVs, are expensive, it's because of that production cost. And I know Hyundai is making a push to produce more of its vehicles here within the U.S. You guys have a multi-billion-dollar investment plan for production for Georgia. What can you tell us about that, and why Georgia?
Yeah, we're very, very excited about our new EV meta plant that we're under construction right now in Savannah, Georgia. The investment is about $5.5 billion. It's going to create over 8,100 local jobs. We're also excited about that as well. And the state of Georgia, they've been very instrumental in helping us, break ground in Georgia. And now we'll have two huge footprints in the United States, one in Montgomery, Alabama, and the other one in Savannah, Georgia. So we're really, really excited about the future.
Randy, when it comes to Hyundai sales, clearly very impressive. You just reported a record number in March, the 5th month in a row of record sales. What are some of the trends that you're seeing from consumers, and how some of their demands are evolving over the last several months and years?
Yeah, well, from a Hyundai perspective, I would say that consumers really gravitate to our brand simply because of design and technology. When you look at our vehicles, from passenger cars to SUVs, we've got a plethora of cars that consumers can choose from. Whether it's EV, whether it's hybrids, whether it's small trucks, we've got a wide range of cars for consumers to choose from. And I would say that a lot of consumers gravitate towards the Hyundai brand simply because of design and technology.
All right, Randy, well, we got the IXIC right behind us. I'm excited to get in this car. We're going to go take it for a spin, really get excited, get in there, figure out what has people so hyped up about this.
Let's go check it out. All right.
We got the sunroof open.
We got the sunroof.
All right, Randy, so tell me just all about the bells and whistles, because when it comes to these new electric vehicles, everyone's so excited about what's on the screen and what you can do with it.
Well, the first things first, I mean, you saw the how beautiful the car is, right?
Yes.
I mean, the silhouette, the streamliner design.
Very
the car
futuristic.
Is absolutely gorgeous, right? There you go.
The 360 view. We can see our producers
right?
in the background here, but certainly you really get, because I think you drag your finger. Here we go. Maybe that.
Yeah, you can spin it around. There you go.
And spin it around. That's really incredible.
Tell me that's not pretty cool, right?
That is very, very cool. Let's talk about range, because that's something that really sets the Ioniq 6 apart from some of its competitors out there. What does that range look like, and how do you keep track of it?
Yeah, that's a great question. So the range is 361 miles on a full charge. And you can see right here in front of you on the screen, right now, this particular car has a range of 141 miles. So it's been driven around the track a few times already this morning with other journalists. But it's by far the most range that we have in any of the Hyundai brands. So a 361, you can pretty much go from LA to Las Vegas on a full charge.
That's good, because a lot of people get that range anxiety. We've been talking about it so much when it comes to EVs. Randy, from your perspective, Ioniq 6, lots of comparison out there to the Tesla Model 3. What do you make of that?
Tesla who? Well, you know what? I can't speak to the Tesla, and I got to give Elon Musk a lot of credit. I mean, I think he's produced a really, really good car. But I personally am, of course, I'm biased. But the Ioniq 6, from a design standpoint and a technology standpoint, I don't think you can do any better.
Certainly was an impressive car. Really no surprise as to how impressive it was. It won the World Car of the Year award, as well as the electric vehicle and the car design awards. When you take a look at that Ioniq 6, again, it starts for just over $40,000 there. That is the base price of that vehicle, but a very, very sleek look, that aerodynamic feel that you are looking at right now. A little bit of a futuristic exterior. So we'll see how well that car sells going forward for Hyundai, and also just pushing their evolution into EVs and a bigger footprint in that space, whether or not that model helps do the trick. All right, well, coming up, new data showing just how much fully remote work is shrinking. Find out what the future of work could look like next. Bitcoin surging over the last month, really since the start of the year. In just the last month, though, up more than 25% as the cryptocurrency seems to be regaining some of that momentum that it had lost last year. And as the price action has picked back up, so have also the discussions about crypto regulation. Our David Hollerith spent the day over at a crypto conference where regulation was in focus. David, what did you learn about that and just the push here that we could potentially see from regulators?
Yeah, I mean, to back to your original point, though, it's a really interesting dichotomy between crypto prices and how regulation is in the U.S. Today at the Chain Analysis Links conference, so Chain Analysis is a blockchain transactions analytics firm, so they cover basically crime in that area. They interface with regulators a lot. We had a regulator at the federal and state level. So Christy Goldsmith Romero, who's a CFTC commissioner, she came in and spoke on stage today. And effectively what she brought up was just the fact that the industry at this point is at a loss of trust. I mean, this is something we've been talking about for months since FTX. But she's kind of underlined that that's still the position. And the CFTC is sort of known to be seemingly more friendly than other U.S. agencies to crypto. And she laid out that it's still, effectively lessons learned from FTX. There's basic things like setting up internal controls at companies, making sure there aren't any conflicts of interest. She also pointed to the fact that, they work with other U.S. state and federal regulators in investigations. And she said kind of, a little forebodingly that we should probably expect more of those.
Yeah, and David, you mentioned the fact that there's been a loss of confidence in crypto, and also even with what's just played out in the banking sector over the last several weeks with the collapse of Silvergate. You also had a Signature Bank as well, and the tie there with crypto. There's been some talk about that out there on the street. Was there any rumors or any talk about that at the conference today?
Yeah, so Adrian Harris, who's the superintendent for the New York Department of Financial Services, essentially the New York regulator that decided to seize Signature. And she had spoke out actually about comments that have come out about whether or not shutting down Signature had something to do with their crypto exposure. And she had sort of pointed out, even though Signature is known as a crypto-friendly bank, that they also actually had pretty diversified deposits. And she said that it was ultimately a matter of liquidity, which was the issue. And she said the idea that it was sort of some kind of target towards crypto, she called it silly and also ludicrous. So that's as much as we have from that. We've heard the department say just as much, but yeah, and David, when we talk about some of the moves that we've seen this week, just real quick, some of the activity and some of those meme crypto plays, and I'm talking about the Dogecoin, because we had Elon Musk turning the icon here to the Doge dog, and that excited some investors. And we saw Dogecoin was one of the top trending tickers on Yahoo Finance earlier this week. It had been some time since then. What do you make of that and just maybe the interest that we have seen within that coin this week? Yeah, I mean, it's tough to explain Dogecoin in that, if you're looking for fundamental analysis, like a stock, you're not going to find anything like that. But industry, crypto analysts who I talk to, actually, they say it's an honest meme coin, which I guess is a translation that as opposed to these other things, it's transparently doesn't necessarily have value, but there also aren't any weird kind of things that investors can't see about it, is sort of how they phrase it. But not to say that it's by any means safe. All cryptocurrencies are tough to understand as far as investing goes. But as far as the meme coins goes, it's clearly one of the largest, and many people say it's the honest one. So.
Yeah, well, I don't know. Elon Musk driving a lot of the action there in the interest of Dogecoin. David Hollerith, great job being on set.
Yeah.
All right. Well, while the coronavirus pandemic certainly sparked a shift from in-person work to remote work, the post-pandemic world, at least so far, is experiencing another shift. New data out from Pew Research Center saying that the amount of employees working hybrid has jumped from 35% to 41% since the start of 2022, while all remote work declining from 43% to 35%. Joining us now, Yahoo Finance senior columnist Carrie Hannon. Carrie, good to see you here. So talk to us just about what's factoring into this shift. And obviously, certainly executives are reevaluating how and when they want their workers to work.
Yeah, great to be here. And yeah, it's like a reversal, a complete reversal from what we saw before, where most people were working remote, and now we're getting back into the offices. And employers are simply saying, we want face time. We want you here. We want you collaborating in person. And they're putting in, some really, demands, and they're not backing down. But at the same time, employees are saying, hey, they're resisting this call back to the office. We've heard this again and again, because most of them say, hey, we'd like to work remote all the time. So there's a bit of a disconnect here, but I think the employers are using quite a few weapons in a way to get people back in. There is an issue. PayScale had done a report. The numbers here are from Pew, but PayScale did an early report that said that employers actually are paying people who work remotely less money than those who come into the office. So it is a bit of an issue, but trust me, it's not completely going back into the bottle. The genie is out, but I do think we're going to see a lot more a lot more hybrid work versus remote work. And I mean 3 to 5 days, 3 days in the office, not 5 necessarily, but 3.
And Carrie, what is the data telling us when it comes to what's helping, what's not helping the remote workers, the hybrid workers, in terms of what employers are seeing with productivity of the sort?
Yeah, that's a great question. I think productivity is still quite strong. The workers themselves feel that they are more remote, where they're more productive when they're remote. They actually feel like the flexibility really helps them with their work-life balance. It makes them feel good about their employer. And they're still getting important. The majority say we are still getting important assignments. We are still getting promoted. So it's not quite, the employers want them back in, but the employees are actually stepping up to the plate, and the performance has been quite good.
All right, Gary, talking about what we could potentially be seeing 6 to 12 months from now, is the hybrid environment, is that here to stay, or more employers, do you think, going to be bringing back their employees to the office?
I think hybrid is actually here to stay, but maybe not as strong as it once was, right? Not pre-pandemic. But I think there is a bit of an understanding that there's a middle ground here. I talked to a woman who has a recruiting firm here in Washington, and she said, her clients, companies, the number of job postings are remote, they're down significantly from fully remote, but they are still looking for the hybrid worker. So I think we're going to definitely see more of that. But there will be some discussion about how do we manage this? How do we collaborate? How do we make these in-person opportunities part of the equation? And I think for younger workers in particular, they really do want to be in the office more than, say, an older, more experienced worker, because they see a lot of benefits from those spontaneous conversations that come up in the office and more idea creation.
Yeah, certainly a number of the surveys do suggest that as well. Carrie Hannon, great to see you. Thanks so much. Let's get to a trending ticker here after hours, and that is Costco. The retailer reporting net sales of $21.7 billion for the month of March. That's up 0.5% from a year ago. However, in the U.S., sales during the 5-week period were down about 1.5%. You're looking at the stock off just about 2.5% in extended trading. Well, coming up, the Chevy Bolt is one of the EVs selling for under $30,000. Our next guest tells us why it's important for more EV makers to offer more affordable cars. Next.
Dave Briggs back here live at the New York International Auto Show at the Javits Center in New York City. To get a broad overview of the entire EV space, we talked to Elizabeth Creer. She's the Vice President of EV Practice at JD Power. Talked about a couple of things: trends in the EV space, limitations towards mass adoption, and also the surprising automaker that is surpassing, in some cases, Tesla when it comes to brand consideration. But we started out with Elizabeth talking about Jeep and the rapid rise in their popularity since we've come out of COVID. Listen to what she told us.
Jeep has such brand loyalty. People love Jeep. And I think this one behind us is a 4xe, so it may be attracting some of the consumers that are looking for that EV option.
Seems to be that transfer from goods to experiences. People want to get out and live and travel, and that fits that. So let's talk about the EV story, which really changed in 2022 with market share nearly doubling. What happened?
In 2022, there was an influx of new EV alternatives. So prior to that, it was primarily the premium segment, but in 22, a number of SUVs and truck EVs entered the market, something that we called mass market, and that really attracted a lot of new buyers.
There's still about a $12,000 price gap between gas and electric. How is pricing changing, and how is that increasing EV market share?
Price matters. Price absolutely matters. Total cost of ownership is very important to the consumer. And since last year, that number was $20,000 gap. This year, it's actually 11. Our latest numbers show an $11,000 gap. And that continues to be offset with federal tax incentives, utility incentives. There's a lot of players in the ecosystem that are helping to bring that cost down.
How important is that sub $30,000 level, primarily represented by that Chevy Bolt?
That's absolutely important also, to have a vehicle that's less than $30,000 that's an EV. And oh, by the way, that doesn't even include all of the money that the consumer is going to save over the life of the vehicle as they're using electricity instead of gasoline.
And Chevy moved into the number 2 spot in terms of U.S. EV sales. What do you hear from consumers about GM and Chevrolet?
We actually talk to new vehicle shoppers every single month, and we ask them, are you interested in purchasing an electric vehicle? 27% say yes, very, very likely. And the number one brand has consistently been Tesla, but the last few months we've seen Chevy overtake them in brand consideration, and Ford is right there behind them.
Wow, I bet that worries Mr. Musk a little bit, not what he wants to hear. So what's the biggest stumbling block, roadblock between really mass adoption of EVs?
The number one hesitation is infrastructure. Consumers, the current owners primarily charge at home, but they want the confidence to know that charging is going to be there in the public, where they need it, when they need it, at the speed.
Where is the biggest problem, the biggest gap when it comes to our charging network? And can it possibly get where it needs to be by 2035 when California and New York begin to phase out gas-powered vehicles?
What we're seeing is what I call a shotgun approach. There's a number of stakeholders that are implementing charging. I think what we need is to make sure that it's in the right places. Where is the demand? Where is the adoption of EV happening? And making sure that charging is where the consumer is going to need it. So location, time is critical. Also reliability. The chargers have been declining in reliability. 1 out of every 5 charging experience is a failure due to reliability. So that needs some improvement as well.
That's a shock. How are the automakers, how are the consumers going to be ready by 2035 to phase out gas-powered cars? Because it's still more than 90% of market share.
Mm-hmm. I think everybody, that's the question that everybody's asking, right? But we do see automakers, we see utilities, we see governments, we see everybody taking a vested interest in the transition, and we're here to help that transition and make sure people have the information they need so that we get to the number as we need to, and we know the changes that need to happen.
Where do you think market share will be by the end of the year and by, say, 25 or 6?
Glad you asked. 2026, we anticipate forecasts that the market share will be 27%.
So what's the story this year in EVs that you're most focusing on? What's next?
I think it is what happens now that we're moving into the next phase customer. It's no longer the early adopter. There's a lot of mass market vehicles, and it's seeing how many of them, as the supply chain issues get resolved, because right now it's difficult to get them. There's announcement of them, but when consumers go to buy them, they can't get them. As that frees up, now we've got market scope. There's selection for them. Let's see how fast that market share rises.
And you can tow up to 10,000.
That was Elizabeth Creer, Vice President of EV Practice at J.D. Power. The one car that says we're moving towards mass adoption of EVs is right behind me. And it, of course, is the sub $30,000 Chevy EV Bolt. More automakers need to find an answer for that. We're going to take a quick break here. And on the other side, we'll talk more about the importance of pricing in the EV wars.
We think about some of these surprises that we could potentially still see in the second quarter of this year and even further out into the rest of the year.
It's the time of year some look out for an April surprise.
The one that I'm still looking at is what happens geopolitically, what happens in Ukraine, and then a derivative of that is what continues to happen with US-China relations.
Thus far, the surprises have really been the resiliency of the labor market, but we do have a backdrop now of a banking crisis that just started weeks ago. The surprise going forward in the next few quarters could be that the economy drops off more than anticipated.
It is our belief that focus would shift to fundamentals, shift to earnings. And on that front, we're already seeing signs of margins compression, earnings contracting for the first time since late 2020.
I'm incredibly boring. I think cash is queen, but I do think it'll change at some point. So I'm looking out for Q2 earnings. I think they're going to be weaker than expected.
At the end of the day, if the earnings are not there, then we could have more problems for the equity market in front of us.
There's been certainly no shortage of surprises in the markets really over the last couple of years, but even just the last several weeks.
Here's what I think that are the biggest risks that I'm concerned about. The Fed's going to keep raising rates a little bit, maybe a couple more times. I think reality is going to set in that the earnings revisions aren't enough. But the real thing that I think is going to be a problem is if we see a reversal of inflation coming down.
Want to take you back to the floor of the New York International Auto Show at the Javits Center. Dave Briggs still live for us. He's been there all day. And Dave, as we wrap up all of our coverage, electric vehicles, EVs, like you said, what's next in that space obviously has been a theme there throughout the day. What about affordability, the ability there to lower the cost of some of these EVs?
Yeah, we talk a lot about the themes, which are luxury and power, right, when it comes to SUVs and pickup trucks. But truth be told, Americans are still practical. They are cutting back. And that's why this car behind me has truly changed the game in EVs. It is the sub $30,000 Chevy Bolt EV. And it has sold 19,700 cars in Q1, the third straight record quarter for the Bolt. And that is why Chevy is now in the number 2 spot when it comes to US EV sales, trailing only Tesla in that category, who, yes, does continue to absolutely dominate market share. But remember, that was the big question coming out of Tesla Investor Day. Would they find a way to build a more affordable Tesla, a sub $30,000 model? And the answer so far is no. In order to get to mass adoption, that's really what has to change. The other automakers are going to have to find an answer to the Bolt. No, it's not sexy. No, it's not powerful, but it is what Americans want to drive. There is still an enormous gap when it comes to EVs versus gas-powered cars, and it's more than $12,000. So Americans want to save money, and this is the way they're doing it right now. Again, Chevy, for the first time, sold over 20,000 EVs in the quarter. 19.7 of them were the Bolt or Bolt EUV, Shauna.
It really shows so many people are looking for those cheaper cars, that cheaper option, sub 30,000. Clearly has been a massive home run success here for Chevy so far. Dave, as we wrap it up, I got to ask you, you were in so many of those shiny models throughout the day. Do you have a favorite?
Oh, man, I hate to say it, but that Ram
I knew it.
1500 is beautiful. I wanted a Jeep Wrangler when I got here. I actually want the Ram Rev now as I leave here. We'll see if my wife lets me get a pickup truck.
I don't know. She might need some convincing. It was a little pricey there, but I agree. That Ram was extremely impressive. Dave, awesome job down there today. Thanks so much for all your coverage.
Over on your right, you will see.
Thanks, my friend.
All right, guys. Well, that will do it for us today on Yahoo Finance Live. Thanks so much for tuning in. You'll see us right back here again tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell. Have a good night.